Welcome to the Adventures in CRE audio series. Join Michael Belasco and Spencer Burton as they pull back the curtain on everything commercial real estate and introduce you to some of the top minds in the industry. If you want to take your skills to the next level and be part of a growing community of CRE professionals across the world, this is for you.
All right, welcome back. This is season 3. We've got a good one for you today. I'm joined in studio by Michael and Spencer. How you guys doing?
Sam, nice to see you.
All right, so I want to go ahead and introduce the topic today. We have, in season 3 so far, we've talked, and maybe you can help me remember, we were talking about strategy, sourcing, capital.
Yep.
And this we're almost calling like a part 2 of capital. Is that right?
Yeah, it really is. So capital, really, we were talking about raising equity. In this episode, we're going to share some more stories and the like around debt, and there's an important distinction between how one raises equity and how one secures debt. So we'll go through that today.
Okay, so again, if this is your first episode, maybe you're a new listener, you're keying into Adventures in CRE, our audio series for the first time. Season 3, we have a theme running through the entire season, which is deal making and deal doing. And the inception of this idea is because, honestly, between the two of you, we've got the complete, really package as far as a transaction is concerned: deal making, deal doing. And I feel like a lot of the last 3 episodes or so have been really focused on the making side. But making deals is great, but if you can't get them closed, they're not worth anything. So we're going to start now. Probably it seems like we're bridging now over to the doing side. So I'm excited. I think everybody who's watching or listening is also excited. So let's go ahead and jump into it. Spencer, I'll turn it over to you first.
Yeah, so when I think about debt, and I'm really now putting my making hat on, in the industry, we call this the business side of a transaction. What matters most are really 3 things when I think about debt. And the first is it's important to understand the lender mindset, right? So many of you listening or watching, you're on the borrower side of this equation. And from the borrower's perspective, this is a real estate investment that has risk embedded in it, and hopefully the return outweighs the risk such that it's an investable opportunity. The lender's mindset is different, right? So the lender has no upside. And since the lender has no upside, it must ensure that its downside is fully protected.
Explain that further. Just to bring it all the way home.
That's really good. It's so simple, but it's right on point. Yeah.
Why does a lender, for those listening, why does a lender have no upside? What's the reason for that?
Yeah, so a lender lends either on a fixed rate, and by the way, there is protection that the lender puts in place even on a fixed rate, right? Because where's the risk in a fixed rate loan? Well, it's changes in interest rates. And so they use certain pricing mechanisms. They include prepayment penalties in order to ensure that even their fixed rate is hedged against interest rate risk. So either they're lending on a fixed rate or they're lending on a variable rate, but it's at some spread above their benchmark, which really essentially what a variable rate does is it pushes the interest rate risk over to the borrower. But at the end of the day, the lenders are either earning that spread above some benchmark, which is essentially a fixed return, or it earns the actual fixed rate that it earns on a loan. And therefore, if you're, you as the owner make a home run on this deal, the lender makes the same amount. Right. If you lose money on the deal, theoretically the lender makes the same amount. Lender has no upside, and so therefore must protect its downside.
So when you're putting the capital stack in your mind and you're looking at, the traditional capital stack, it's GP. They're typically the most aggressive. They're the ones that are selling the dream. You have the LP who's somewhere in between. The LP stands to earn more the more successful it is, but they need to bring the clouds to the ground a little bit is kind of the way you think about it. And then the debt, it's all about preserving their capital. What are the risks? Because I have no upside. I don't care how successful you are. If you're moderately successful, I'm making the same. If you're going to go in the tank, I hope I'm protecting from that downside. So,
well, what's interesting about that is just from a perspectives, like just understanding the different perspectives, the mindset, the approach. I mean, the way you communicate with people, that is like the central, that's the hub, that's the catalyst of your results in your career. Okay. And so if you're talking to a GP and LP, whatever the case may be, you really have to know what their motivations are. And if it's to protect capital, in this case, we're talking about debt, then you got to talk to them in that way. So that's a foundational just structure, just something where we need to start the conversation there. Mm-hmm. So as we talk about debt structures and the capital stack, that it all makes sense, because there's quite a few nuances from the last podcast where we talked about raising capital, relationships with people and things like that, networking. This is largely guidelines to an extent. And I'll let you, Spencer, kind of explain it better.
Yeah,
but
I think they're definitely the things that we talked about in the previous episode around relationships and experience are relevant as it comes to securing debt.
Right.
But really, there's more to it. It's understanding that lender mindset allows you to frame conversations and present your deal in such a way where it understands where the lender's coming from, right? It encourages you to be patient with a lender that needs to check its boxes, and it's not all just bureaucratic. It's very much the lender knows what its downside is, and it needs certain documents. It needs to go through a certain process in order to ensure that downside is protected. And that can be difficult. Maybe I'll give my first example. And this was, so I think all of us are aware now through the stories that we've told over the last few episodes that I spent a fair amount of time developing housing projects in Panama, right? And so how that process worked is we were the developer. So we secured the land, we lined up the contractors, we entitled the property. We were also, though, the builder. And so we would develop the property, and then we had our own in-house construction workers, for lack of a better term. Yep. Team, yeah, who put the walls up, who put the plumbing and electrical. And
all with equity.
No, we had debt.
Okay.
And that's a different story. So where I'm getting with that is we essentially would bring the house to completion. And in the meantime, we'd gone out and we'd actually pre-sold the house. Okay. So we had a borrower in place. That borrower, with our help, in a way, we were a mortgage broker as well. Right. It's very vertically integrated in Panama. And so we would connect that borrower with a lender. Okay, and that lender would provide financing to that borrower so that they could purchase the home. And one of the lenders that we and our buyers would work with was called Banco Nacional de Panamá. It was the National Bank of Panama. It was a public bank. So for one, you have the bureaucracy just of a public sort of entity like that. But then you had the realities of a lender and a lender mindset. Mm-hmm. And, those of us who sit on the equity side, when we say equity, GP, and LP, time is money. Mm-hmm. And we think about that all day long. And so it's like, how can we do this faster? And there's always this urgency. Well, lenders don't generally have urgency, and even less so public lenders. And so our very first phase, we put out this whole block of homes. And how the phasing worked, at least how our capital worked, was, and the loan that we had with our construction lender, we could not start the second phase until the first phase was completely sold. And sold meant closed. And so we had to wait on the end lender's process to close, to pay us, right, to ultimately close the house. We would, it would return all of our equity capital. We would pay back our construction lender, and then we could start phase two. And most of the end lenders right, that were providing the financing to our buyers were reasonably fast. Now, they still took twice as long as we had anticipated because their requirements were such that, again, that lender mindset, there's not urgency. It's very much, give me these 30 items, and then I'll close unless I find 2 or 3 other things that I also might need at the last minute.
I was just going to say,
right?
you're missing a critical phase.
Yeah.
Go ahead.
Yeah. So we were pretty frustrated. We were stalled. We have this whole team of people
right.
who are on payroll, right, who are meant to be building houses. They were just sitting on the sideline earning a paycheck, but not actually working. Right. And it came down to this very last lender, Banco Nacional. And we had to close 4 final homes with them. And a week after week would go by. And pretty soon we're worried about being able to pay our people, right? Because we've got finished houses, we've got people that are on the payroll, and nothing is happening. And on top of that, right, it's like, and there's this bank. And so I had this moment where I was feeling some serious stress, largely because there was a question whether we would be able to continue to make our payroll. And so I set up a meeting with the head of, call it that department, to talk to this individual. And by this point in time, I developed a fair mindset around how lenders think. Early in my career, I was a partner in a mortgage company, and so I understood to a certain degree. Now this is a whole different country. And literally here, I went in the door, hat in hand. I remember sitting in the lobby 3 hours. I kid you not, 3 hours in the lobby waiting to speak to this individual.
Wow.
And I went in to this individual's office and essentially, in as diplomatic as I could, pled for those last 4 homes to close and tried to understand, what exactly are you needing? What's holding these last 4 homes up? And, you know, my pad and paper, what can I do to help you? And we laid out some items, and he said, if you can get me this and this by this date, I'll commit to you that I'll have these last 4 closed. And we did. I mean, we rushed immediately. And that's
how much of a time frame was that from?
I think it was 10 days.
Okay.
And that's another lesson here is.
Can I ask a question real quick?
Go ahead.
I should know the answer to this question, by the way. Was the construction lender the same bank?
No.
Okay, so it's 2 separate banks.
2 separate banks, yeah. In fact, the construction lender did also provide financing to buyers, and they were much faster, right? Because they had slightly different incentives. They were sitting on both sides of this equation. But in this case, there was no urgency at all. And in my experience, virtually all lenders are this way. And that's because protecting their downside is so important that they can't rush anything. And there are lenders that move really fast, and don't get me wrong, nevertheless, a lender in needing to protect its downside must cross all its T's, dot all its I's. And so in this case, what I had to do is humbly accept that these are the things the lender needed. Whether I thought that they were reasonable or not, the lender needed these items, and it was my job to provide them so that we could get to the finish line. And we did. And it worked out okay. We went on to the next phase, and we learned our lesson from that.
I wonder if, I don't know if this is, I know we've got some notes and some general ideas of where we want to take this, but I'm actually kind of curious now, based on the last couple of episodes we've done, when we're talking about debt, capital, everything that we've been talking about over this episode and the last one, how much of that is taken into consideration when we're at those beginning phases, that strategy phase? Because because in a way you develop a capital stack strategy at the strategy phase, is that right?
Yes. You need to understand where your capital is coming from at the strategy phase.
Now, you might not be dialed in, but you will have a general idea in the early part of that.
Okay. So maybe, and I don't know if this is kind of derailing where we're going, but I'm kind of curious at the starting phases, okay, how does the money, let's say we've already kind of talked about relationships and, how to get, capital, and now we're talking about debt. when we're starting, how does it chronologically, how does it flow? How do we kind of, use the two pieces? How do they work together? I mean, in this case, you were talking about a construction loan, and then we're talking about a takeout loan.
Yep.
So then the construction loan can redraw
Right.
again, right? So talk to me about when you're talking about does this make sense if we go back and talk about kind of the strategy phase?
The process, or?
Yeah, the process. I guess what I'm getting at is, I think the nature of debt is it seems like that makes sense to me. Mm-hmm. But I'm wondering when you're operating, and Michael, this is to maybe your like when you're operating the finances of the business, I imagine that you're almost like on a daily basis looking at, okay, debt, equity, reach out to that person, reach out to how do those two things balance out? And when you start something, I'm guessing you're forecasting. So I just want to know, like, when you look at the chronological, the implementation of the stack, I guess is what I'm asking.
Well, it depends on what type of project you're working on. I mean, it's constant. You need to be constantly focused on liquidity, timing. When do you expect equity to come in? What's the process for drawing equity? What's the process for putting debt in place? So, whatever it is, if you're development, typically it's equity out first, and only when that equity has been placed will the debt start to come in. So, it depends. I mean, for us, when we're putting portfolios together and things like that, we have to manage. We have a set amount of capital to purchase properties on the equity side, a set amount of debt. Each of them have their processes, and we need to just manage that. So we look, you could look 1 month, 2 months out and just time all that. When are you closing your property? How much lead time do each of these entities need? And you manage accordingly. So it's really tailored to the individual strategy or project. Now, if you're doing a one-off, purchase, they'll close. Typically, debt and equity will close simultaneously, and then you go through the whole process of doing by what you then get that debt procured. But equity is usually committed earlier than debt, I think, almost across the board. So,
Yeah. Oh no, it most definitely does. Right. The debt's going to look at the equity, because the equity is the borrower. It's the sponsor. It's the it's the group that is either going to make or break the deal. And when you think about one element of downside for a lender, it's a borrower that doesn't know what they're doing. And so it's rare that debt will be secured before equity is in place.
Okay. So I'm wondering now, so you get terms from both equity and debt. Like, you can draw against your equity to specific, whatever your prearrangement is. Is that how this works, basically?
Yeah.
Okay. And you're doing the same. You have some maybe more, because you're working with the debt in a more complex way.
it's more structured and rigid.
Yeah.
I would say it's more structured and rigid is how I would think about it. There are guidelines there. And plus, you have guidelines in place, and there's rigidity in the equity structure, but you got to think about the incentives of the equity side versus the debt. So if something isn't going according to plan per se, and you need to go back to your equity partners, and maybe there's an opportunity to have a better outcome, right? Those are things that I think an equity or LP and GP collectively might entertain and change. With a debt or capital part, or with a lender, it's much more rigid and structured. So I don't know if you.
And again, it's because they've put boxes around every one of their downside risks. And so if you're going to change things, they go, okay, well, now I need to rethink about every place that I could possibly lose money and ensure that this change doesn't affect the protections that I put in place to eliminate or reduce those downsides.
Mm-hmm. So yeah. So again, if this is a one-off, you've structured something with equity and then debt. You pretty much created your box so that the lender will look at it. You're not flip-flopping around, and you're not going to go to a lender with a strategy that then you trade on during the negotiation. Obviously, that's not gonna cut it.
So let's take this episode, and I don't want to repeat the last episode, but how do you procure a debt partner, right? Because we talked about last time relationships and being creative, different things like that. Your investment strategy, all of this. I'm guessing it's almost very parallel to what we talked about on the equity side.
Yeah, somewhat. the lender cares less about the strength of the strategy. I mean, they care a lot, right? Because there's downside risk, but they care less than your partner. They care more about who the borrower is and their ability to pay the debt service. They care more about the past than the future. That's another big distinction between, say, an equity partner and a lender. A lender generally is backwards looking. Like they're not in the business of
hopes and dreams.
Hopes and dreams. Yeah. That's exactly right. And so on stabilized assets, they're going to look at the last 2 years of operating statements, and they're going to base their underwriting on that. And they might believe a little bit about what could happen over the next 3 to 6 months, but they're certainly not going to buy some story years into the future like an equity partner might.
They're still projecting, they're still doing their DCFs and projecting into the future, but you're not selling them the dream, I think is the point.
So picking an equity or a debt partner, what's the mindset? What's the process for doing that? I mean, I know that it seems like when you're going after LP money, for example, you are looking for somebody who catches the vision, right? I'm guessing it's different for debt.
Yeah, it is. There's far more relationship. The relationships matter far more in the equity side than the lender side. I mean, the relationships matter still a lot, but it's more of a marketplace in the sense that when you need debt, you go out and you get multiple quotes, and you weigh those quotes against one another. And if there's a relationship that weighs in the decision, but ultimately from a borrower standpoint, it comes down to who's going to provide the best terms, who do I believe will execute in the best way, and oftentimes that's okay. Who's lending me the most money at the best rate with the most flexibility?
Yeah,
you're still pitching to the lender, by the way. Your strategy. It's not that you're not selling them the dream. It's just it's a different perspective. You still go out there and pitch, give presentations, whatever you need to do in that regard. But
what's interesting is, and I've worn a lender's hat a couple times throughout my career, the strength of your strategy doesn't really impact pricing. I mean, it does to a certain degree, but not like in equity where it really makes a big difference. It's more the lender says, how risky is this? And then they price accordingly.
So I have a question. I started my career out in residential mortgages. And when I first started, the relationship between the underwriter and the loan officer and the processor was, kind of, once you caught it, it was like, oh, okay. And one of the things that I learned really early, not that I was great at it, but I learned really early that the way I present my my documentation and my file to the underwriter would make the transaction super simple at the beginning or super complicated. And a lot of times what I found was when it was and you said something that made me think of this. When it was complicated, it was because I gave them too little up front. Like I gave them, maybe just income and assets and things like that. I didn't really give them anything else. I'm wondering if there's a parallelism when we're talking about institution level lending, and if you could either share the nuances and maybe some case studies or something along those lines.
Yeah, well, no doubt. And this is really to the doing side now, right? So one thing is on the when we say making, on the making side of securing debt, it's really about going out there, getting quotes, lining up your quotes and choosing the right quote, negotiating then a term sheet. And the term sheet really is the terms of, so a quote comes in, but then you negotiate a term sheet, things like what's the term of the loan, how much interest only, what's the rate, what kind of prepayment options do I have? Can I prepay this without a penalty? Usually no, and so therefore, what's the prepayment cost, and what's the structure of that? And then you get into a whole host of things around who's the guarantor, or what type of guarantee must be in place. Is the loan simply guaranteed by the entity that owns the real estate, or is there a principal guarantor, a separate entity or a separate individual that is guaranteeing to the bank something, and what type of guarantee, right? So in a lot of commercial loans, they're non-recourse, meaning there's no, if the loan goes bad, it's only on the real estate, and it's not to the individuals that are behind the borrower. But there are often what are called bad boy carve-outs, right? These are call them exceptions to the non-recourse element, where so Sam Carlson takes out a commercial loan on an industrial building, and if the loan goes wrong, the lender's only recourse is to the building, meaning they can foreclose on the building, take it back, sell it, and hopefully recoup their capital. However, if you, Sam Carlson, as the borrower, perform or do some sort of bad boy acts, maybe you put the entity into bankruptcy, maybe you pocketed rent and didn't use that rent to pay debt service, maybe you failed to pay property tax when you should have under the loan. There's a whole variety, and those are negotiable, by the way. So when I talk about like the term sheet, what you're really negotiating are all these sorts of points that aren't in the quote. Once you negotiate that term sheet, it's usually non-binding. And now we're all talking making at this point. Non-binding. Then now we bring the attorneys into the equation. And you have your attorneys and I have my attorneys. And by the way, I'm paying for your attorneys and my attorneys. Okay?
Awesome.
That's how this works on the debt side generally. And those attorneys start negotiating now a whole host of other things, like what documents must Michael and the doing side present in order to close, and what kind of insurance must be in place when this closes, and
timing obligations, all kinds of things, which the doing team then gets.
Yeah, the sort of things that really makes us, like on the making side, our eyes glaze over, and the attorneys get all sorts of excited about. And we've already negotiated what we call the business terms, and the attorneys dig into the balance of it. And at some point, we sign a loan agreement, and once that's signed, this process really passes over to the doing side.
So let's pass it over to the doing side.
Yeah, let's do it.
You know, again, because I was in the loan game, I know the momentum of a transaction where you get a deal, you're under contract. That's the fun and exciting part. You know, the money's already in the bank, you know, in your mind, but then it passes over to like the nitty gritty.
Yes.
Right. And so I just want to maybe give an overview of the nitty gritty, and then do we want to talk about some of the pitfalls that the potential pitfalls that happen in that process, and maybe we could even resolve some of those in the process of that conversation. So what am I saying? An overview
we can do
of the doing, and we'll go from there.
Yeah, let's do an overview. It's part and parcel to probably another episode we'll do here, which is the overall due diligence process. And a lot of what we do in that process is part and parcel with the lender. So a lot of the reports we're getting, a lot of this stuff is what we're providing to the lender. So basically, it's what we've pitched and promised, you know, what the making team has pitched and promised to the lender is actually what it is. And that they're going through their process, as are we, to verify that it is indeed what it is. So they're going to commit capital to what we had told them they were committing capital to. So, you know, it's a process. I guess I would break it out in terms of, let's break it out in terms of entities and sort of what they do. So once this happens, once the deal's in place,
right,
we're going to commit capital, there's really obligations of all the parties. There's lender obligations, there's the borrower obligations, there's even obligations from the seller, and there's obligations from the tenant, okay? So property or the loan gets signed up. First thing that happens typically is a lender will go out and find an appraiser, and we'll get an appraisal underway.
Right.
All right. And I'm going to stay high level because we don't want to get in the nitty. So there's an appraisal that gets underway. That's usually under the lender's obligation. The borrower, so all the due diligence stuff, we're talking, you know, phase ones, PCAs, the surveys, seismic if applicable, zoning reports, title commitment.
Right.
You know, these are typically the big buckets of which we are underway already during due diligence, but as we're going through that and when we're finalizing these documents, we need to present those things. And we can go into, I think maybe we'll go into a little more detail into those in this
Yeah.
episode, but maybe we'll hold off on
Yeah.
that. Then you go to the seller side. So there are certain obligations. The lender is, again, looking to secure every and any downside. So there's a couple things that need to happen. They need to make sure that their mortgage or deed of trust, whatever it is in first position, most senior position, right? So they'll look to whatever state or municipality you're operating in. There'll be a draft mortgage or deed of trust. You'll have a local counsel go and make sure that it's legit so that it can be recorded. They'll look to get an SNDA. So the seller will initiate two pieces of paper, which are pretty important: the estoppel and the SNDA. Okay, the SNDA is really the document that the lender cares about. It's subordination, non-disturbance, and attornment. So subordination meaning the tenant agrees that the mortgage interest is first priority. They're acknowledging that and signing off on that. Non-disturbance means that in case anything happens with the GPLP, the equity
Borrower.
side, the borrower, borrower, when they go in to take over the property because of that issue, they agree to acknowledge the lease is in place and leave the tenant alone to operate their business. They won't disturb them. And attornment is basically the inverse, that if the person who the tenant signed the lease with, the landlord, is kicked out, they acknowledge that the new landlord is a party to the lease, and they won't bail on the lease or anything. So SNDA, making sure the mortgage is recordable, that is really between tenant and landlord. Between tenant and seller.
Lender.
So, Well, the seller has to request these documents. The seller has to request the estoppel, and actually in some cases, has to check a box to request the SNDA as well if it's a form SNDA. Now, in the space we're in, SNDAs are usually not negotiated when you're dealing with national tenants, but on either bigger deals or certain deals where there's a lot more risk, there's a negotiation that happens between the tenant and the lender. So, did I miss anything? Is there anything that was
All right, wake up.
a large?
Yeah.
Sorry, was that a total?
No, well, at the end of the day, it's not that you did anything wrong. It's that the process is detailed. It is, there's a checklist. There's a lot of things. There's a lot of documentation, a lot of due diligence, a lot of people doing the CYA thing, right? So in its nature, it's not
sexy.
No, it's not. Yeah.
It'll put you to sleep, but it's there's an art to it, The key is organization, organization and communication. Yeah. And if there are ever any issues or problems, it's always about, and this is where relationships come in, making sure that you can work through those. Now it's harder to do that on the debt side, but always keep communication, making sure you're getting documents when you say you're going to get them, and just making sure that process is well organized.
Yeah.
So.
Go ahead. I was going to say, I think a really important aspect to this is anticipating the needs and wishes of your lender partner, right? And by the way, that's a whole other point is treat your lender like a partner. We can get to that at another point, but try to anticipate the needs of the lender. So Michael listed off a laundry list of items. We call these closing conditions or conditions of approval, depending on the stage at which they're required. And every loan may be a little different about what they require, but it's a long list. And when I say anticipating what could go wrong or what are the pitfalls, hopefully you know your property well enough and you know your lender well enough to know where there might be issues and bring those up sooner rather than later. Let me give an example. I was on the lender side wearing a lender hat for a residential property. It was actually senior housing with a borrower that we had dealt with quite a bit. And they brought a property to us, so one-off property. Like I said, residential property built in the 90s. Now, if you're familiar with construction in the 90s, plumbing was either copper or polybutylene piping, and they call it poly. And it was I mean, I don't know what it is. It's some form of plastic that they liked in the 90s. The problem with poly is that about 30 years in, it starts
To leach?
To leach. Yeah, maybe
Just
you
to
understand.
break down,
that.
right?
But essentially break down, right? And this particular property had polybutylene piping. So before we spent any money, and I say we, the lender, in the case, sometimes it's the borrower that initiates the property condition report or the environmental. Other times it's the lender who initiates, and just every lender is going to be a little different. In our case, we would initiate the property condition report. And before we did that, the borrower, who had a great relationship with, came to us and said, I want you to know there's poly in this property. And before we even spent the money, there was a discussion saying, are we comfortable lending on an asset that has poly? And there was a week of discussions. Ultimately, the answer was no. And the borrower then went off to another lender that was, I guess, more comfortable with poly. But because
Or unaware.
or unaware, yeah, that
happens.
It does happen. But because they knew the sensitivities of the lender, they were able to bring that to the forefront right at the beginning, rather than wasting money and time only to discover. Which, by the way, what would have happened had they not done that is a property condition consultant would have been engaged. They would have gone out to the property. They would have spent. The borrower would have spent $5,000 in order to get this 100-page report. That amongst that report, one page would have said there's polybutylene piping in the property.
Yeah.
Throwing up the red flag, circling of the wagons internally on the lender side to decide, is this an issue? What can we do? Maybe we escrow, maybe we have the borrower escrow $500,000. Let's find out how much it costs to replace poly with copper. And in the end, likely it would have been a loan that wouldn't have proceeded, and the borrower would have spent $40,000, $30,000 in due diligence only to discover that. Yeah.
My question is so Spencer, in the deal making side, how much are you doing to mitigate those types of scenarios so his side is more vanilla? You want your side as vanilla as possible,
correct.
Right?
Yes.
And so, Spencer, when you're doing what you're doing, I would imagine that, putting my loan officer shoes back on, sometimes you want to just, like, the idea of just getting deals and doing deals, there's so much driving that ambition that you only have the rosy colored glasses on, and so you kind of maybe you overlook those things. Think, we'll be able to handle that, or whatever the case may be. So sorry, go ahead, Michael.
Yeah, you take it away. I just want to say there's a constant feedback loop, by the way, that happens between the making and the doing. Like there will be things learned. We see tax busts and lease, or tax caps, there's leakage, there's things like that, or we learn about certain geographies which have high transfer taxes that we discover. There's this constant feedback loop, into which allows the maker side or the sourcing side to get smarter on that stuff too. So they protect us, and then we keep. It's a nice.
Yeah, and as it relates to the lender, really, what I would say is ultimate transparency. Never think that you can slip something by your lender. First off, eventually they'll find out, and they may find out after they've lent you money.
Yeah, you may it's actually worse if you get away with it.
Oh yeah, but much worse, because they'll then know that you knew and didn't tell you, and either you've been in breach of some contract that you signed, or even almost worse,
you're incompetent.
They view you as either incompetent or unethical. And what's interesting is all these lenders know each other. They speak to one another, and just because you think, I'll just never do business with that lender again, that's just the wrong way. So the right way is complete transparency. What you disclose what you know, when you knew it, as soon as you know it.
Yes.
And look, some lenders just can't do it. Another example was, and this is an example where the borrower did not know of a situation. And what was that situation? Large apartment complex, out of state investor, actually a huge private equity firm, and this was one asset in a large fund, and they were looking to just basically recast the debt with some nice long-term debt. And one of their assets was huge apartment complex in a major market. And I think, if I recall right, it was a garden style deal, but if I recall right, there were 28 buildings. One of the buildings had an easement that ran underneath that building. And why was there an easement? As the investigation went along, this actually came through the zoning and survey report. There was actually a major water line that ran underneath this building, 16-inch water line, which is huge, that serviced the entire neighborhood. And what would happen if that water line were to burst underneath that building? They could have the right,
oh my gosh,
to tear down that building. And so this is something that comes up in the due diligence. The borrower didn't know, but as soon as this came up, there was a discussion arose. And ultimately what happened was you have to carve out that building and you have to lend a little bit less. And, the borrower, anyway, it was complicated. But because, again, a great borrower, they ended up working well with the lender. They came to a conclusion. Lender couldn't lend quite as much, carve out this one building so it wasn't at risk. But sometimes you know up front, sometimes you don't. What matters most is that you are a borrower that discloses what you know when you know it.
The process sounds like it could be as ambiguous sometimes, yes, based on the situations, right? And I'm wondering, though, from a person looking, let's say, Michael, I start working with you today. Mm-hmm. Speaking broadly, some broad strokes, what are some of the definite things, impediments, problems, potential issues that you've learned that you say, hey, we just got to make sure that we, yes, like, where do people go astray, I guess, maybe some of the key areas?
So I think from a high level, the most important thing that needs to happen from the get-go is that the expectations are clear and set out right from the get-go. How this process is going to work, what the lender needs, and there can't be any ambiguity. That's very important.
So are you getting that information directly? Who are you being clear with, I guess?
The process needs to be clear between how things are going. So documentations that are required or things that are needed, whether it's pre-closing or post-closing, if there are certain requirements. And the lender sometimes stipulates that, and you need to know as the borrower, you need to know what their expectations are, and you need to make sure that they're clarified. So you can roll all the way through a process, get to the very end, for example, assume an SNDA or an estoppel, for example, maybe a post-closing item. Right. Mm-hmm. You get to the day of closing, and the lender comes back and says, actually, we needed that. We need that pre-closing, which could then delay your closing, creates a whole big situation with brokers, your reputation. There's all kinds of things and implications that could happen. So making sure that your expectations are understood of both sides. And really, you as the borrower need to make sure that you're meeting the lender's expectations and making sure that they're clear. So that could be anything, but really just making sure those documentations are delivered on time and as expected.
So maybe if I'm hearing you right, so basically the idea is because there's nuance to every deal, just go in with as clear a plan as possible, mm-hmm, and being able to adapt as quickly as possible, right?
Yeah, right. If this is a one-off property, it should be more straightforward, like what the expectations are. If you're running a continuous platform and you have a large pool of
or
debt,
development.
Or development.
I mean, development's the same way. You're drawing capital constantly, and I think the key really is communication. And so if you're running the process right, you have a weekly deal call with your lender, right, and you're talking about what's needed, what are the blockers to get those things done, and this applies both if it's an acquisition loan or a refinance, so just a kind of simple financing, or whether it's a more complicated loan like a development facility or line of credit or the like. You meet once a week, you talk about what needs to get, what the lender's needing, what's holding you back, and that sort of process it really makes it smoother. It's never smooth, really, but
reporting protocols. It's organization and communication. You get those in line. Like Spencer said, weekly meetings, any type of reporting documentation, depending on what type of project it is. Just make sure that all of that there's a regular cadence, which is, I think, critical.
Well, I think that the last piece of this, and I know we're running up against our time on this episode, but Just because you get the loan closed or even the equity closed, that's not the end. In fact, there's as much, if not more, work that goes after that.
Post-closing.
Post-closing, yeah. So your lender's going to expect quarterly reports. In some cases, monthly reports if it's like a construction facility. Your equity partner is going to expect monthly or quarterly reports. And there's as much, if not more, work in that than there is in getting to close.
It's more standardized and predictable, but there's work there. It's not like a one-off, but it's on repeat and it's continuous, and there's a lot there too.
Until something goes wrong.
Yeah.
Right? So there are certain covenants that must be met each quarter to be in compliance, right? If something goes wrong and you break a covenant, now all of a sudden there's a lot of work that has to go in because the lender's going to start questioning. So every lender's a little different, but they'll generally have a list of properties that are out of compliance. And the terminology varies by lender, but essentially it's a list of properties that are in trouble or may be in trouble. In fact, some lenders will have, you have a list of properties that are actually in trouble, and then there's a list of properties that might be in trouble, and so we should watch lists of sort. And if you're the borrower on either of those lists, you're going to have greater scrutiny. You're going to be taking phone calls every week or every month from your lender asking, what's going on with this? And
you don't want to get on that list. So it's funny, I was taught it's critically important to get those reports on time, never late, and always right. And what's going to happen, at least what I've told, is that maybe there's people looking at them. The only time it really matters is if there's a problem. So it's an unsung hero. Just make sure it gets done, making sure you're doing that, because you don't want to hit up on the potential problematic property. You'll never get out of that box. So,
and it's almost like there's a fiduciary duty to each party. Like the fiduciary duty to an equity partner is take care of our money, but we want to grow it, right? And the fiduciary duty to the debt side is, hey, we've got depositors. I'm thinking this is largely coming from depository banks and or pension funds or things like that, where the strategy is just to, preserve capital and maybe keep up with inflation. I don't know. Did you want to say something?
Well, we can go a lot of different ways. There's a lot of different lenders, and their reason for lending varies, right? So you have depository banks, you have syndicators that syndicate and then sell to larger pools of capital. You have pension funds, which have their own, but generally pensions are lending through a kind of investment management firm that puts their money out. Life insurance companies, which are one of the larger lenders in commercial real estate, and what they're looking to do is match the duration of their liabilities, life insurance policies, with assets that have the same duration. And so therefore what they care about is that money, debt service comes in every single month until the very end of the predefined term. And if it doesn't, either you prepay it or the loan goes bad, then they're in trouble because they're matching that with a long-term liability like a life insurance policy or some other insurance policy. And so every lender is going to have different reasons, but usually catch that at the onset, right? That's going to the lender you choose will depend on right. your investment, but at the reporting stage, they're all kind of the same, right? They want to make sure that you're paying your debt service and that you're likely to continue to pay it. And that when the loan comes due at the end of the term, that there is that you'll be able to come up with money to pay the balloon payment, right? Because in commercial loans, they're not generally fully amortizing, meaning they're not at the end of the loan term, there's a balance almost always. And they want to ensure that the asset that is securing this loan is sufficient to pay off the loan at the end of the term. And so all of this reporting is what they're thinking about. Every time a report comes in, it's like, okay, am I still going to get my debt service? And will they be able to pay off the loan at the end of the term?
Anything else, Michael?
No, I think that's great. We could go on about different types of lenders, but I think we're
I'm starting to glaze over.
I was starting to glaze over. Well, I think to your point, I think we're going to do some more in depth. I mean, we really have gotten down and dirty into the process somewhat. I know we didn't talk about it all. I mean, there's a lot of things that go through the processes.
It's challenging to go like the checkbox, and make it
engaging,
lively. So we'll try to balance that.
Yeah, no, I think my big takeaways from this is, I mean, a lot of the same skills the skills and tactics that we're using from the previous, efforts, relationships, communication, strategy, these are all parts of this process. So the debt side is a big side to success in your strategy. And without it, you're not, I mean, there's no real strategies without some level of debt. Right?
In most cases, yeah. Debt's almost universal to investment strategies. I mean, you see all equity strategies, but they're rare.
Okay. Well, if you've been listening to this, hopefully it was very enjoyable. We will, look forward to the next episode where we're going to talk more about the deal making and doing. And until then, we will see you real soon.
Thanks for tuning into this episode of the Adventures in CRE audio series. For show notes and additional resources, head over to www.adventuresincre.com/audio series. Would you like to learn real estate financial modeling in a matter of weeks and do it with zero guesswork? If so, the A.CRE Accelerator is for you. The Accelerator is a step-by-step, case-based program designed to teach you exactly what you need to know and in the order you need to know it, so you can gain both the knowledge and experience to take your career to the next level. To see if the Accelerator is right for you, go to www.adventuresincre.com/accelerator.